In this video, we're going to talk about the reclassification of liabilities, whether it needs to be changed from long-term liabilities to current or from current into long-term. Now think about why this might be important. If something is in a long-term liability, well then it's not included in ratios like the current ratio. If it is included in current liabilities, and let's say it's a bond, a huge amount of money that's going to be retired in the next year, well, that's going to change liquidity quite a bit, or it could potentially. So understanding where these liabilities are classified and making sure they're done properly is very important. Let's look at an example. Tobacco Incorporated issued $750,000 of bonds on December 15, 2018. They pay interest annually at 5% on December 31st. Let's look at the entries for this bond. First, on the date that they're issued, we show cash coming in at $750. Bonds payable is classified as long-term, $750. They go through the time and they pay their interest every December 31st. And now we're in that last period right before they're going to become due. So on that date, December 31st, 2022, we take the entire amount, bonds payable, and we reduce the liability account, and we call it current maturity of bonds payable. So now we have gone from having a long-term liability to a current liability. The company can reclassify short-term debt as long-term debt if, these are important, it is expected to be extended or replaced by debt that will be due beyond 1 year or the balance sheet date, or the company has already replaced or refinanced the short-term debt. U.S. GAAP sets two more criteria. One, management must intend to refinance on a long-term basis, and they must demonstrate the ability to consummate the refinancing. It can't just be an intention, we have to have some proof about it. Management demonstrates its ability to refinance by either completing an actual refinancing during that period between the end of the fiscal year and while they're getting the financial statements ready to be issued, or they can show some evidence that shows a firm agreement that it's going to permit refinancing on a long-term basis. So it's already been approved that they will be able to get loans. Let's just look at one example of this. So now we're going from short-term debt to long-term. Okay, so we've got Barbero Buildings. They have a short-term note payable, $478, and it's going to be due in the next operating cycle or period. So it is considered short-term. Now, Barbero extended the term of the loan for part of the balance, changing the due date to 2020 instead of 2019. Okay, how should they classify this? Let's take a look. The refinancing, remember, was for $300,000, so we're going to take that portion of it and take it out of the short-term notes payable and put it into long-term notes payable. Here's the journal entry. You're not responsible for IFRS debt reclassification, but I do like this slide because it has a little bit of a nice summary here. So short-term debt, it's expected to be refinanced. When can we report it as long-term debt? We can do it if it's refinanced before year-end, if it's refinanced after financial statement date but before the financial statements are issued, or it's after financial statement date but we meet those two other criteria. We intend to refinance and we demonstrate the ability to be able to do it.